Well, happy Monday. Glad to be back in the saddle after a nice weekend. I went up to the mountains with my kids and did some camping with them and extended family. And boy, I'll tell you, it was a little bit brisk in the morning. I think fall is on the way officially. We're only a couple of days away from the calendar giving us fall weather, but it sure felt like it up there in the mountains, that's for sure. But happy to be back in the saddle today to talk about a few things focused on interest rates and where things are headed here with the Federal Reserve. This is Fed week this week. So by Wednesday, we'll expect an announcement from the Federal Reserve after their two-day meetings that start today, kick off today, on whether or not they plan to raise the overnight lending rate again by 0.25% this Wednesday. All expectations are that they will not. If they do, it will shock the market, and we will see interest rates go quite a bit higher, quite quickly. I don't anticipate that to happen. Nobody does, which you never know. Maybe that means it will happen. But at this point, the markets are expecting the Fed will pause, not raise interest rates this week, and wait until their November meeting. So 2 more months before they make that decision. So they have more time to digest jobs data and inflation data. So speaking of which, last week, as we talked about, we had the consumer price index, CPI came out, and it came in kind of mixed. I mean, we knew that there was going to be some increase in energy costs, right? We had at least a 10% increase at the pump on gas prices. So we saw energy prices increase as part of the CPI report, but we saw used car prices come down. We saw a number of other things come down, like the lagging indicator of shelter in these large urban areas that the CPI report covers. Talked about the fact that this lagging indicator of rents, of leases that are expiring and then people renewing for lower amounts, is starting to show up in the data. So this lagging effect of the rents is starting to help the overall inflation data. But the headline inflation still jumped up a bit year over year, mostly because of the higher energy prices that we saw in July and August that kind of crept into that August report. Now, the core CPI is in the low 4s. That came down slightly, just as expected, or close to as expected. So that's still coming down, and that's because that lagging indicator of rents is starting to kick in. So that's good news. But because of the mixed report, it had a kind of a muted reaction in the market. There wasn't a lot of change on interest rates because of that. So we'll see what happens this week. All eyes are on the Fed as they meet for the next 2 days, determining what they're going to do with interest rates on Wednesday. If they hold and pause, and there's a growing chorus of Fed members that are voting and non-voting members, there's a variety of those around the country, that are saying, hey, we may have gone far enough. Let's stop. Let's see how it reacts. Let's allow the economy to kind of catch up and spending habits to catch up and everything else to work through the economy before we make any adjustments. And there's starting to be a larger growing chorus of dovish Fed members that are more willing to say, pause, let's not do any more. But I don't know that they're in the majority yet. So we'll see what happens, of course, this week and then as well on Thursday. I want to show you some interesting charts here today, though. Let's talk a little bit about the 10-year Treasury. That's a leading indicator for mortgage rates. And right now, as you can see on the chart here, I'll scroll down. You can see that we're bumping up against this ceiling of resistance that we've hit today, and also again on August 22nd. That's 4.3, 4.36, 4.35, that range on the yield for the 10-year. That's a critical level. That's a Fibonacci level, a technical resistance level that's now serving as an overhead ceiling of resistance. If the 10-year were to break above that, that would cause interest rates to worsen kind of fairly dramatically. We could see an 1/8 quarter, maybe even up to a 0.5% worse interest rate, depending on the 30-year fixed mortgage rates, depending on how high that yield went this week. So the only reason it would do that, of course, is if the Federal Reserve decided to raise interest rates again and it shocked the market. So we got to keep an eye on that. Another thing that's interesting to look at here, and I opened this up so you can see this. You have the 10-year here showing that we're at 4.31, 4.32, which we just talked about. But there's other coupons. There's other treasuries out there. There's a 1-year treasury. There's a 2-year treasury, a 7-year term treasury, and a 30-year. Typically, in a normal economy, if you're an investor and you want to invest money in a fixed income asset like a security, like a bond or a bill, debt note, if you will, you're going to expect to make more money on your investment if it's a longer term investment versus a shorter term investment. Well, as you can see here, you can make more money on a 1-year than you can on a 30-year. Okay, what this is called an inverted yield curve, where they take a longer term duration, like a 10-year, and they subtract it from the 2-year. That's typically how you look at yield curves. Let me show you what that would look like over time. So a yield curve, the negative yield curve, is right now we're in negative territory. It's much more negative than it has been even prior to previous recessions, right? Like in 2006, 2007, we had a negative yield curve, and this negative yield curve is one of the factors that indicates that a recession is coming up. It's typically a very reliable indicator. As you can see, we're going back 40 years here. The only other time we've had a yield curve that's more negative than now was back in 1980 and 1981. And that, of course, those are pretty high interest rates. So we haven't hit a recession yet, but as you can see, this negative yield curve tends to happen right before a recession happens. The recession on this chart, recessions are indicated by the shaded areas here. Those indicate recessionary times. So right before typically a recession is when you have this negative yield curve. And we have a very steep negative yield curve where you take the 10-year minus the 2-year and it's negative, which is unusual because typically you'd expect to be paid more for a longer duration bonds, longer duration treasuries. So very interesting chart to keep an eye on. And we've been negative for quite a while now. We've been negative since last June of 2022. So it's been quite a long time. But still, we haven't dipped into a technical recession yet. Now, when recessions happen, usually interest rates come down. That's a natural result because the economy then needs to be stimulated, right? So the Federal Reserve tends to drop interest rates at that point. And that usually stimulates housing as well. So recessions don't necessarily mean that housing is going to fall apart unless it's a very steep, very deep recession. Then at that point, people get very nervous about their employment stability and their income, and they don't want to buy anything. But if it's just a shallow recession, it really doesn't hurt real estate much at all. In fact, in most cases, real estate continues to do well. It might plateau for a while, but then it continues to appreciate even during recessions that are fairly mild to medium. So we'll see what happens here. It's going to be an interesting time. Taking a look at the markets today, as far as the 30-year fixed bond, right? If that the universal mortgage-backed security bond for mortgages, here's where this looks today. This is the inverse of the chart we just looked at again. So this is price, not yield. We're looking at price here. And as you can see, my chart just freaked out. As you can see here, we have some improvement in the bond price right now, but we're up against the 25-day moving average, which is usually, it's considered kind of a leash, right? If you get too far above it, the market kind of gets back down to it. Too far below it, it snaps back to it. So this is kind of a leash effect, this 25-day moving average. And right now we're up against it as a ceiling of resistance. So we'll see what happens over this week. All eyes are on the Fed on Wednesday. Whatever they say, whatever comes out of their mouth in pre and post-game interviews, and of course the official announcement of what they're planning to do with interest rates will be very critical and will move markets. Have a good week.